You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. Today, we're tackling a really fundamental question. How do you take your first $1,000 and actually build an investment portfolio?
Right.
We've looked at the strategies, the data, and our mission for you, the listeners, pretty simple. A clear roadmap. Turning that initial $1,000 into a real foundation for building wealth. And let's just say it up front. Forget needing a fortune to get started.
Absolutely. That is the biggest myth, I think, that stops people. We really need to just dismantle that idea. Investing isn't some exclusive club.
Right.
And starting with $1,000, it's not just possible. It's actually pretty smart. It lets you, learn the ropes without feeling this huge pressure.
Right. Less risk while you figure things out.
Exactly. And maybe more importantly, we want to help shift your mindset. This isn't $1,000 to just spend. It's capital. Capital you're putting to work.
Okay. Capital deployment. I like that. But before we even get to where to put it, we need to talk readiness, right? Financial preparedness.
Oh, definitely. You absolutely need that basic safety net first. We're talking an emergency fund, maybe $500, maybe $1,000, something set aside.
And crucially, dealing with any really high-interest debt, like those credit cards charging, 18, 20, 25%?
Yeah, exactly. You just can't reliably outinvest that kind of interest rate. It's like trying to swim upstream against a really strong current.
Makes sense. So let's circle back to that myth, needing big money. Why is that idea so damaging?
Well, it makes people delay starting. And in investing, time is probably your most powerful asset, honestly, thanks to compounding. The sooner you start, even small, the bigger the impact down the road.
Compounding, yeah. We'll dig into that.
Think about Warren Buffett. It's a classic example, but it's good. He bought his first stock when he was 11.
11, wow.
Yeah, with just $38 back in 1942. Now, obviously, $38 was more back then, but the point isn't the amount. It's that he started small and early. That builds momentum.
That really puts it in perspective. So this $1,000 we're focusing on, it's not just sitting there. It's like your entry ticket.
Exactly. Your ticket to becoming an investor, maybe eventually a part owner in businesses, potentially building something that could last generations.
So that mindset shift you mentioned, from consumer to capital deployer, that's really the core of it.
It fundamentally changes how you see your money, doesn't it? Instead of thinking, okay, $1,000, what can I buy right now? Like a new gadget or a weekend away.
Instant gratification thing.
Right. You start seeing it as a seed. A seed that could grow into something much, much larger over time. But like we said, putting that seed in fertile ground means having that financial stability first.
The emergency fund, the debt management.
Yeah, that high interest debt. It's just a constant drag. No investment is guaranteed to beat those kinds of rates consistently. It's just working against you.
Okay. So mindset shifted, finances prepped. Now what? Where does this $1,000 actually go? It feels like a lot of choices out there.
It can, yeah. And this is where your own goals, your personal financial goals, and crucially, your timeline, they become really important. Well, think about it. A 22-year-old saving for retirement, decades away, their strategy is going to look really different from, say, a 35-year-old who needs a down payment for a house in just 3 years.
Right. The time horizon changes everything. Different risk tolerance, different needs.
Exactly. The time horizon dictates how much risk you can comfortably take on and what kind of investments make the most sense for that specific goal.
Okay, so for this deep dive, let's assume our listener is thinking long-term wealth building. Let's say minimum 5 years out, but ideally, much longer.
Perfect. That longer time frame is key. It lets you ride out the market's inevitable ups and downs, the volatility.
Which we know will happen.
Oh, absolutely. But more importantly, it lets you really harness the power of compounding. That's where your investment earnings start generating their own earnings. It's like a snowball effect.
Okay, so what does success look like realistically over the long term? We hear numbers thrown around.
Yeah, well, historically, if you look over long periods, the stock market has averaged somewhere around 10% per year. Now, that's crucial. It's an average.
Right, not a guarantee each year. Some years up, some down.
Precisely. Some years are much higher, some are negative. Volatility is just part of the deal. But over decades, that 10% is a reasonable historical benchmark for broad market returns.
Okay, so let's see that compounding thing in action. What could happen to that initial $1,000?
Okay, let's take that $1,000.
Yeah.
If it grew at an average of 10% per year for 30 years, purely hypothetical, using the average, it could become over $17,000.
Wow, from just the initial 1,000.
Just from the initial 1,000, thanks to time and compounding. But here's where it gets really powerful. What if you didn't just invest the $1,000? What if you added just $100 every month?
Okay.
Same scenario, 30 years, 10% average annual return. That initial $1,000 plus the consistent $100 monthly contributions, you could potentially end up with over $200,000.
Okay, that's pretty eye-opening. The consistency makes a massive difference.
Huge difference. It's the combination. Starting, time, compounding, and consistency.
All right. So with that long-term view and the power of consistency in mind, where do we actually put that first $1,000? What's the practical starting point?
For that first 1,000, honestly, one of the simplest and most effective strategies is using index funds.
Index funds. Heard the term, but break it down.
Okay, think of it like this. Instead of trying to pick one winning horse in a race, you're betting on almost all the horses. An index fund lets you buy a tiny, tiny piece of hundreds, sometimes thousands of companies all at once.
So you're not trying to find the next Apple or Google.
You're basically buying all of them, or at least a huge chunk of the market. It's instant diversification packed into one single investment.
Okay, I get it. Diversification meaning spreading out the risk, right?
Exactly. So, for example, if you invest in an S&P 500 index fund, you own a small slice of the 500 largest U.S. companies. You know, the big names: Apple, Microsoft, Amazon, Google, Tesla, hundreds more.
Okay.
The beauty for beginners is that instant diversification. Your risk isn't tied to just one or two companies. And the other huge plus, they are typically very low cost.
Low cost. How low are we talking?
We're talking annual fees, they call them expense ratios, often well below 0.1%, sometimes even lower.
0.1%. So on $1,000, that's like $1 a year.
Less than $1. Take Vanguard's Total Stock Market Index Fund ETF, the ticker is VTI. It gives you exposure to basically the entire U.S. stock market. Its expense ratio is currently around 0.03%.
Wow.
On your $1,000 investment, that's just 30 cents per year. 30 cents.
That's incredible. Compared to
actively managed funds, these are funds where a manager and their team are actively picking stocks, trying to beat the market. They often charge fees of 1%, maybe 2% per year, sometimes more.
So instead of 30 cents, it could be $10 or $20 a year on that same $1,000.
Exactly. And that difference might sound small initially, but over 20, 30, 40 years, those higher fees dramatically eat into your returns. It's like a slow leak draining your potential growth.
Got it. Okay, index funds sound like a really sensible, cost-effective starting point. So how do we actually construct a basic portfolio with our $1,000 using these?
Well, a really elegant and popular approach, especially for getting started, is something called the three-fund portfolio.
Three-fund portfolio. Sounds manageable. What are the three funds?
It typically consists of 1, a U.S. total stock market index fund, 2, an international stock index fund, and 3, a bond index fund.
Okay, U.S. stocks, international stocks, and bonds. Why those three?
They represent the main big buckets or asset classes you want exposure to. Stocks, both here and abroad, give you growth potential. Bonds generally offer more stability and income, and they often move differently than stocks, which helps smooth out the ride. It's about diversifying across different types of investments.
So U.S., global growth, and a bit of stability with bonds. Makes sense. How would you split the $1,000 between them?
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
For a younger investor, someone with decades to go, a common starting point might be something like 70% in the U.S. stock fund, maybe 20% in the international stock fund, and 10% in the bond fund.
So with the $1,000, that's like $700 U.S., $200 international, $100 bonds.
Yeah.
Roughly.
Exactly, roughly. And as you get older, maybe closer to when you need the money, you might gradually shift that balance, maybe adding more bonds to lower the risk.
Yeah.
But honestly, when you're just starting with $1,000, don't get too hung up on hitting those percentages perfectly. Even putting the whole $1,000 into a single, broad, total stock market index fund is a fantastic, diversified start.
That's good to know. Keep it simple initially. Can you give us some actual examples, like fund names or ticker symbols people could look up?
Sure. For that broad U.S. stock exposure, Vanguard's VTI is great, like we mentioned. Schwab has one called SWTSX. Fidelity has FZROX, which is one of their zero-fee funds.
Zero fee, wow.
Yeah. For international stocks, Vanguard has VTIAX, Schwab has Swiss. And for bonds, Vanguard's BND or Schwab's SwagX are solid broad bond market options.
Okay, that gives people concrete things to look for. And can you actually buy these with just $1,000? I thought some funds had high minimums.
That used to be more common, but one of the great things now is that many brokers offer these index funds, especially the ETF versions like VTI or BND, with no minimum investment. You can often buy even fractional shares, so your $1,000 gets fully invested.
Perfect. So accessibility isn't really an issue anymore. Now, where do we actually buy these? We need an account somewhere, right?
Correct. You need a brokerage account. Think of it as the place, the platform where you buy and sell investments like these index funds or stocks.
And where do we open one of those? Any recommendations?
The ones that usually come highly recommended, especially for beginners, are the big discount brokers. Think Fidelity, Charles Schwab, and Vanguard.
The big three. What makes them good choices?
Well, first off, they all offer commission-free trading for most stocks and ETFs, which is huge. No cost to buy or sell these index funds we're talking about.
That's key.
Yeah. Plus, they generally have really good customer service, robust online platforms, great mobile apps, and tons of educational resources for investors.
So when someone's choosing, what should they look for specifically?
Definitely check for no or very low account minimums. Make sure they offer commission-free trading on the specific funds or ETFs you're interested in. Look at the website and app. Is it easy to use? Do they have good customer support if you need help? And those educational tools can be really valuable when you're starting out.
And you mentioned Fidelity has some zero-fee funds.
Yes. Fidelity has pioneered some index funds like FZROX we mentioned earlier that actually have a 0% expense ratio. That's literally as cheap as it gets. Hard to beat free.
Can't argue with that. So say someone picks one like Fidelity or Schwab. How hard is it to actually open the account? Is it a hassle?
Not usually, no. It's surprisingly straightforward these days. You'll need your basic info. Social security number, probably a driver's license or other ID, some info about your employment, and your bank account details to link for transferring the money.
Okay.
The whole application is typically done online, and honestly, you can often get through it in maybe 10 or 15 minutes.
Wow. Okay. So not a major barrier at all. Get the account open, transfer the $1,000. Now, before we hit buy on those index funds, is there like a special type of account we should be using to make this even better long-term?
Yes, this is a really important optimization. We should talk about tax-advantaged accounts, specifically individual retirement accounts or IRAs.
IRAs. Okay, or retirement accounts. Even if retirement feels ages away.
Especially then, these accounts offer significant tax benefits that can seriously boost your long-term growth. Think of them as like turbochargers for your investments.
Okay, turbochargers, I like that. What are the main kinds?
The two main types you'll hear about are the traditional IRA and the Roth IRA.
Traditional versus Roth, what's the difference?
Okay, simple version.
Yeah.
With a traditional IRA, your contributions might be tax deductible now, which lowers your current tax bill. But you'll pay income taxes on the money when you withdraw it in retirement.
Okay, tax break now, pay taxes later.
Right. With a Roth IRA, it's the opposite. You contribute money you've already paid taxes on, so no upfront tax deduction. But the huge advantage is all the growth, all the earnings, and all the qualified withdrawals in retirement are completely 100% tax-free.
Wait, tax-free growth and tax-free withdrawals later on?
Exactly.
Yeah.
Decades of potential compound growth. And you never pay taxes on it when you take it out in retirement, assuming you follow the rule.
That sounds incredibly powerful, especially for someone young who has decades of growth ahead.
For most young investors who are often in a lower tax bracket now than they expect to be later in their careers, the Roth IRA is usually the way to go. Paying the taxes now, while your rate is relatively low, to get tax-free growth forever, it's a fantastic deal.
So that $1,000 going to $17,000 example, in a Roth, that whole $17,000 could potentially be withdrawn tax-free.
Precisely. No tax bill on that $16,000 of growth. It's a huge benefit.
Wow. Okay. Is there a limit to how much you can put in? Can we put our $1,000 in?
Yes, there are annual limits. For 2025, the IRA contribution limit is $7,000 per person. So your initial $1,000 fits comfortably within that limit.
Great. And can we buy those same index funds like VTI inside a Roth IRA?
Absolutely. You open the Roth IRA account at your chosen brokerage, Fidelity, Schwab, Vanguard, And then you use the money in that Roth IRA to buy the same low-cost index funds we talked about. It's the same investment, just housed within this tax-advantaged wrapper.
Okay, so a Roth IRA seems like a really smart move for that first $1,000. Now, the money's in. It's invested in an index fund inside a Roth IRA. What's the next challenge? What trips people up?
Honestly, often the biggest hurdle is psychological. It's managing your own emotions once you see your money actually invested in the market.
What do you mean?
Well, there's this natural urge, especially when you first start, to check your account balance constantly. Every day, maybe multiple times a day.
Guilty as charged, probably.
Right. And you'll see it go up, you'll see it go down. Sometimes it might drop noticeably in a single day. And that can trigger fear, anxiety, the urge to do something, sell maybe, or change your strategy.
It feels like you should react to the swings.
It feels like it, but reacting to short-term noise is usually counterproductive. It's so important to internalize that market volatility, those ups and downs, is completely normal. Expected, even.
It's not a sign something's broken.
Not at all. Look at the long history of the stock market. The trend has been strongly upward over decades. But along the way, lots of bumps. Actually, if you look at the S&P 500 since 1928, it's had positive returns in roughly 3 out of every 4 calendar years.
So about 75% positive years,
Yeah.
meaning down years happen maybe 1 in 4 years on average.
Roughly, yeah. Negative years are part of the landscape. You have to accept that short-term volatility is kind of the price of admission you pay for the potential of achieving those higher long-term returns that stocks have historically offered.
The price of admission. I like that framing.
And the investors who really hurt themselves are the ones who panic during those inevitable downturns and sell. They lock in their losses and often miss the recovery that follows.
So what's the practical advice? How do you resist that urge to constantly check and react?
A good rule of thumb, honestly. Try to check your portfolio maybe once a quarter, 4 times a year.
That's it.
That's usually enough.
Yeah.
Any more frequently, and you risk making emotional decisions based on short-term noise rather than your long-term plan. Another great tactic is to automate your future investments if you can. Set it and forget it to some extent.
Let the system handle it, remove the emotion.
Exactly. Patience and discipline are key. Let time and compounding do their thing.
Okay, that makes sense. And that touches on something else. This initial $1,000 is just the start, isn't it? It's not a one-and-done thing.
Oh, absolutely not. If you're serious about building wealth, consistent investing over time is the real powerhouse. The $1,000 is laying the foundation.
So how does that work best? Just throwing money in whenever?
A really effective strategy for consistent investing is called dollar cost averaging.
Dollar cost averaging. Okay, what's that?
It's simple, really. You commit to investing a fixed amount of money at regular intervals, say every month or every paycheck, regardless of what the market is doing.
So same amount, same schedule, whether the market's soaring or dipping.
Precisely. Here's why it's smart. When market prices are lower, your fixed dollar amount automatically buys more shares of the index fund. When prices are higher, that same amount buys fewer shares.
Okay. So it kind of averages out your purchase price over time.
Exactly. It averages out your cost per share, and it helps reduce the impact of trying to time the market perfectly, which is nearly impossible anyway. It enforces discipline.
And you mentioned earlier the impact of adding just $100 a month.
Right. That example where the initial $1,000 plus $100 monthly at that historical 10% average over 30 years could potentially reach around $200,000. That's dollar cost averaging in action combined with compounding.
That really drives home the power of consistency. What if someone can't manage $100 a month right now?
Even smaller amounts matter. Whether it's $50 a month, $25 a month, whatever you can consistently afford. The key is starting the habit. Make it regular. Automate it if possible through your brokerage. That consistency is more important than the exact amount, especially early on.
Start the habit, make it automatic. Got it. Got it. So we've got the plan, the account, the first investment, the commitment to add more. What are some common mistakes people make that we should try to avoid?
Oh, there are definitely a few common potholes. Number one is probably trying to time the market, thinking you can jump in right at the bottom and sell right at the top.
Which you said is basically impossible.
Pretty much, yeah, for almost everyone. Remember the saying, it's time in the market, not timing the market, that builds wealth. Just stay invested.
Okay, what else?
Another one is jumping into picking individual stocks too early before really understanding the basics or diversification. It's tempting to chase hot stocks, but it's much riskier than starting with broad index funds.
Stick with the index funds initially.
Definitely. We also talked about checking your portfolio too often. That leads to those emotional decisions. Another mistake is actually not starting because you feel $1,000 isn't enough. But as we saw, compounding makes even small amounts powerful over time. Starting today is better than waiting.
Right, the cost of waiting.
Exactly. And then there are fees. Paying high investment fees unnecessarily. Those 1-2% fees on active funds really add up and drag down your returns compared to low-cost index funds.
You cost low.
Absolutely. And finally, a big missed opportunity is not using those tax-advantaged accounts like the Roth IRA. Leaving that tax-free growth on the table is a significant mistake over the long run.
Okay, those are really good warnings. Market timing, stock picking too soon, checking too often, delaying high fees, ignoring IRAs. Lots to keep in mind. Now, looking further down the road, once the portfolio grows beyond $1,000, maybe $10,000 or more, are there other things to consider?
Yes, as your portfolio grows, and hopefully your knowledge grows too, you might explore other areas. But always master the basics first. Don't rush into complexity.
What kind of thing?
Well, you could look into REITs, real estate investment trusts, if you want some real estate exposure without buying property directly. You might decide to increase your international stock allocation a bit more for broader global diversification.
Okay.
Some people, once they're more experienced and have done their research, might decide to allocate a small portion of their portfolio to carefully selected individual stocks, understanding the risks involved.
Small portion, keywords there.
Absolutely. Or you might look into slightly more advanced strategies like factor tilting, maybe adding a bit more exposure to small cap stocks or value stocks. But again, these add complexity and potentially different risk profiles. Basics first.
Basics first. Got it.
Yeah.
So it's an evolution. Once we have this initial portfolio set up, say the 3-fund model, is there any regular upkeep needed? Like tuning up a car?
That's a good analogy. Yes, there's a concept called rebalancing.
Rebalancing. Okay, what's that involve?
Remember how we set target percentages, like 70% U.S. stocks, 20% international, 10% bonds? Well, over time, because different investments grow at different rates, those percentages will drift.
So if U.S. stocks have a great year, that 70% might become 75% or 80%.
Exactly. Your portfolio gets out of whack relative to your original plan and maybe your risk tolerance. Rebalancing is just the process of bringing it back to your target.
How do you do that?
You essentially sell a bit of what has done well, the part that's now overweight, and use that money to buy more of what has lagged, the part that's underweight. So in that example, you'd sell some U.S. stocks and buy more international stocks and bonds to get back to 2010.
So it forces you to sell high and buy low in a disciplined way.
That's the idea. It imposes that discipline. Now, you don't need to do this constantly. Doing it maybe once a year, maybe twice a year is usually plenty. Overdoing it can lead to extra transaction costs or taxes if it's not in an IRA.
Once or twice a year, check up and tune up. Makes sense. As the portfolio grows past $1,000, are there milestones where things change significantly?
Yeah, think of that $1,000 as just planting the seed. As it grows to, say, $10,000, $25,000, $100,000, a few things might open up.
Like what?
Well, sometimes minimum investment requirements for certain fund share classes drop. For example, Vanguard has Admiral shares for many of their mutual funds, which have even lower expense ratios than their standard investor shares. But they might require, say, a $3,000 or $10,000 minimum per fund.
So potentially even lower costs as you grow.
Potentially, yeah. Also, with a larger portfolio, you might have more flexibility to implement slightly more nuanced asset allocation strategies if you choose to, or maybe consider things like target date funds, which automatically become more conservative as you near retirement.
But the core ideas still apply.
Absolutely. The fundamental principles, diversification, keeping costs low, focusing on the long term, consistency, those don't change whether you have $1,000 or $1 million. They're timeless.
It really is a long game, isn't it? A marathon. How do people stay motivated over decades?
That's such a great point. It is a marathon. And staying motivated is key. One thing is to actually acknowledge and, celebrate the milestones along the way.
Like hitting $5,000 or $10,000.
Exactly. And maybe use those quarterly check-ins we talked about, not just to rebalance, but to review your progress. Look at your total value. See how much came from your own contributions versus actual investment growth. Maybe seeing that growth encourages you to increase your monthly contribution if your income has gone up.
Track the progress.
Yeah, maybe keep a simple spreadsheet or use the tools your brokerage provides. Seeing that net worth number climb over time, even slowly at first, can be incredibly motivating. It shows your plan is working.
And remember the why, I suppose.
Totally. Remember why you're doing this. It's not just about numbers on a screen. It's about building financial security, confidence, freedom, achieving future goals. every dollar you invest is a dollar working for your future self.
This has been incredibly helpful, a really practical guide. Let's try and quickly recap the main steps for someone ready to invest that first $1,000.
Okay, let's do it. Step 1, financial readiness. Make sure you've got that small emergency fund, maybe $500 to $1,000, and you've got a handle on any high-interest debt like credit cards.
Right. Foundation first.
Step 2, open the right account. Strongly consider a Roth IRA for the tax-free growth. Choose a good low-cost broker like Fidelity, Schwab, or Vanguard.
Roth IRA at a major broker. Got it.
Step 3, invest that $1,000 simply and effectively. Put it into a low-cost, broadly diversified index fund. A total stock market index fund, like VTI or similar, is a fantastic starting point. Or the simple 3-fund portfolio if you want bonds and international right away.
Keep it simple, keep it diversified, keep costs low.
Step 4, make it consistent. Set up automatic monthly investments, even if it's just $25 or $50 to start. Build the habit. Dollar cost averaging.
Automate consistency.
And step 5, patience and discipline. Resist the urge to check constantly or tinker based on headlines. Stay the course. Trust the long-term process. Let compounding work its magic.
Stay the course.
Remember, that initial $1,000 left alone at historical average rates could become $17,000 in 30 years. Add $100 a month, and it could be over $200,000. The potential is huge.
It really puts it in perspective.
And honestly, the biggest difference between people who build wealth over time and those who don't often just comes down to starting and then being consistent. Taking that first step is critical. Your future self will definitely thank you.
An amazing overview. Okay, a final thought for you, our listener. Thinking about your own future, what specific goals could this first $1,000 investment and the consistent investing that follows help you achieve? And based on that, what's one concrete action, one commitment you can make today to set that plan in motion? Thanks for taking this deep dive with us.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.